Money Talks is sponsored by Astound Broadband, powered by Grande.
Well, you've got one. You might not even know what it is, but when it comes to qualifying for a loan like a car loan or a home loan, you have a credit score. And that determines for whoever is giving you that loan, the odds that you will pay it back and how much interest they think you should be charged. So on this week's All New Money Talks, what composes your credit score? Your credit score is made up of many factors, and we will get into that. But first, why is a credit score so important?
Credit scores have a huge impact on our lives. When we apply for credit, our score is going to impact the interest rate we pay, so a low credit score could lead to high interest charges over time. In addition to getting credit, credit scores can impact things like homeowners insurance or auto insurance, our cell phones, or even our ability to get a job.
So when it comes to those credit cards, car payments, and mortgages, what is the most important thing for establishing good credit?
Paying your bills on time will have the largest impact on your credit score. Even one 30-day late payment can lower your credit score by 100 points or more. I recommend that people set up automatic payments for their loans or credit cards so they never miss a payment and they're never late to help keep their credit scores high.
And remember, starting good habits tomorrow will eventually pay off and raise your score.
An older credit score will be more stable, so it's important to keep credit cards around even if you're not using them. If you do want to close an old credit card, make sure you haven't used it for at least 2 years or more before you cancel it. To have a high credit score, you want to keep an eye on your utilization ratio. So for example, if you have a $10,000 limit on a credit card, you want to make sure that at any given time during the month, you don't have more than $1,000 charged on it, even if you pay your balance in full at the end of the month. You want to keep that utilization below 10%.
Okay, so Neil says keep the credit low, but there's a good reason not to close the account.
And it might feel good to close a credit card with a balance on it to keep you from charging more on it, but just know that this will reduce your available credit because you close it, but that outstanding balance will still count toward your utilization ratio. So instead of canceling the card, just cut it up while you pay off that balance.
And one more tip, you don't want to have your credit checked too often.
Applying for new credit, like a new credit card or a car loan, that's known as a hard inquiry, and it could impact your credit score for up to 12 months.
And Neil did go on to say that you should have a mix of credit. The remaining portion of your score has to do with your credit mix. So it's good to have different types of credit like that credit card, a car loan, and a mortgage, since they do each affect your score differently.